Hi, I'm Nicholas Bohnsack, President of Strategas and Head of Portfolio Strategy. Another week has gone by. We've got a number of good questions in the Baird mailbag, so we thought we'd take this opportunity to hazard our best answers for a number of them. I'd say one of the principal issues that the market has been grappling with over the summer is to try and measure the health and general fundamental strength of the equity markets and balance that against what I think are some slightly lower expectations for economic growth. It became pretty clear that inflation, which we'll talk about in a minute, is less transitory than perhaps policymakers had first suggested or perhaps hoped that it would be. And at the same time, given a stickier inflation environment, we also started to see some sluggish growth on the economic front. And so ultimately, I think this growing number of uncertainties has compelled us to reduce equity exposure. I'd say the straw that broke the camel's back, which is to say, why now, really sort of sits within the Beltway down in Washington, D.C. I think the proclivity of this administration to sort of go for its most aggressive policy initiatives is going to cause a little bit of consternation and ultimately is going to make investors less certain. And of course, investors loathe uncertainty, number one. Number two is, I think there's a lot of question marks around the debt ceiling and taxes, and those two issues are going to come right to the forefront here as we move through the end of September and into October, and as we move out through the end of the year. So that was really the straw that broke the camel's back. I think we've had just a growing package of uncertain data points that investors are going to have to grapple with. And then the last little bit really goes back to monetary policy, which is, of course, the Fed's bailiwick. And what we found here is that despite their best efforts by Chair Powell and Vice Chair Clarida, they've been unable to convince the market that tapering their bond purchases isn't tantamount to starting the clock for interest rate increases. Historically, those two have been associated. I think the Fed is trying its level best to disassociate them this time around. I'm not sure the market believes them. And the reason that this is necessary ultimately is because right now we have a monetary policy mix that's not quite the right antidote for a supply shock, which we're experiencing here in some of the unevenness in the global supply chain. So the confluence of all of those compelled us to take our equity exposure down from, I'd say, a sort of an outer limit optimism at around 67% in the benchmark portfolio down to about 62% over here in the last week. All of this, particularly as it relates to inflation, is to try to inoculate portfolios from our vantage point, but ultimately something that both businesses and consumers will have to consider here in the months ahead. Each of us, to the extent to which we still drive combustion engine cars, are seeing it in terms of prices at the pump. You're seeing it when you go to the market and buy food for your family's table. And businesses are certainly having an untoward amount of pressure on the producer price side, and a limited success, quite frankly, at this point, passing it on to the consumer. But the more that those pressures mount, the more inflation will sort of be resident in the current economic paradigm. So for investors, the best thing to do is inoculate or try to inoculate the portfolio against those higher inflation readings. And we think a first sort of pass at that is to try and manage the volatility of inflation expectations. Over the longer term, 12 months, 15 months, 24 months, equities are going to be a very good place to hide and again, to hedge higher levels of inflation. But there's a bridge. There's a bridge between lower levels of inflation and higher levels of inflation. And it comes by way of, as we've mentioned earlier here, the volatility of inflation expectations. So that's really what we're trying to address by increasing an allocation to gold, increasing our allocation to short duration credits. So as we've taken our equity exposure down, we obviously have to sort of put that allocation into other buckets. And what we've chosen to do is to split it with a modest preference for fixed income securities, particularly short duration investment grade corporates and bank loans. These are two asset classes or sleeves of the broader fixed income asset class that should do well for a sort of temporary to intermediate term allocation, particularly as the volatility of inflation expectations rises. We also moved a little bit of, or increased our exposure to cash, and we've stayed away from increasing our exposure to gold, albeit our gold within our broader asset allocation sits at a rather high 400 basis points, so 4% of the total portfolio. And so the combination of short duration investment grade credit, bank loans, and gold within the cash exposure column are really meant to counteract the volatility of inflation expectations, which should be elevated and probably to a certain degree more volatile as we move into the beginning part of next year. We would not anticipate that we start to see a 70s style inflation or to wit a 70s style stagflation, but we certainly will have the hallmarks of some of that. Slightly more moderate growth on the one hand, slightly stickier inflation on the other. And we think short duration credit and gold will help counteract that in a balanced portfolio.